No.
Oh. Cool, Matt. I got you. I'm just trying to get you all organized.
Hey, Tyler, how are you?
Good. Everybody else
I just want to make sure the only thing I really care about is how do I share my screen to, there we go.
Figured out?
I think so.
Perfect.
Okay.
Matt, can you hear me?
Say that again, Michael?
Can you guys hear me all right?
Yeah.
Okay.
So these two.
Yeah. Pretty good.
Oh. These two. Red caustic the whole thing and shut it down with its arms down. So it's going to caustic send those lines. Actually, we blast it out and see if it gets a particular.
The upper left-hand corner, it does show where it shows attendees. There's also a chat function. And a Q&A function. So if you go into the chat function, you can ask questions to anybody that's
I think we'll give it a few more minutes for some people to log on if they're in the midst of that, and then we'll get started if that's all right with you.
Sounds great. Thanks, Mike.
Sounds great.
Okay, I think we'll go ahead and we'll get started. Thank you everyone for joining. My name is Mike Fenwick, Account Executive here at Strategic Tax Planning. Thank you for joining our presentation on tax planning for your brewery, compliance, credits, and incentives. We also want to give a thank you to Riley, John, and Tyler at Brewer Magazine for hosting this webinar for us. I think a big reason that we're all here is one, because we enjoy beer, and two, in the process of brewing it, if there's ways for us to save and ultimately profit from it, we'd like to help you guys explore that. So with that being said, I'll go ahead and hand it over to Strategic Tax Planning's Managing Director, Matt Eddleman.
Awesome. Thank you, Mike. And so, Mike, why don't you go ahead and give yourself a little bit more of an introduction? It sounds like you I might have skipped you over your slide there.
Yeah, so my background is, comes from the college coaching world and athletics. So I'm used to working with a lot of people from a lot of different walks of life. Really enjoy helping businesses, in this case breweries, from the smallest startups to ones that have production in the millions of dollars in revenue, and also that production in their beer process. So if there's what we can do to help, that's what we're here for.
Awesome. Thanks, Mike. And so my name is Matt Eddleman. I'm the Managing Director here at Strategic Tax Planning. And a little bit about me. So I've had a background in finance and taxes for the last couple of decades at this point, especially focused on how tax planning and the incentives and credits that are found in the Internal Revenue Code can benefit the everyday taxpayer. So I spent a good deal of time in the financial planning world, working in investment management, and saw so frequently that we were pushing our clients into things like index funds, which can be lower risk and decent returns in the long run. However, it makes it difficult for taxpayers to take advantage of the incentives and credits that can be found in the tax code. And so I've been particularly focused, as I mentioned, on tax savings over the last several years. Particularly over the last 3 years, I've been particularly interested in helping my clients access the credits, incentives, and opportunities that were found in the CARES Act and the other pieces of pandemic relief legislation. And so just before we get started, I'll just share with you all that my favorite type of beer is, no question about it, an oatmeal stout. How about you, Mike?
I have to go on the lighter end. I'm not quite the connoisseur that you are, but I just look for a straight Stella or Heineken. I'd have to probably go with those are my two top choices.
Understood. I go with the bottom fermenter. So I spent a good deal of time in the food service industry. I actually first started working behind the bar, going back all the way to 2004, I believe, was the first bar position. So I have a particular soft spot for the businesses in the food service and the food and beverage industry. So thank you so much for sharing your time with me this afternoon. So we'll go ahead and get started. Just a quick disclaimer: this information, of course, is for information purposes only. If you would like any advice about your specific tax situation, please feel free to reach out to us directly. So I'm going to go ahead and get started and talk about our agenda for today. So first thing we're going to be talking about is selecting your entity classification. What type of, how are you going to elect to be taxed at the federal level? This is something that is a pretty basic first step for many businesses, but something that is often, underplanned and not considered thoroughly enough. Next, we'll get into our quick discussion regarding the Corporate Transparency Act, which first took effect on January 1st of this year, and the reporting responsibilities for just about every single business owner that's probably on this webinar today. Next, we're going to get into a discussion of the research and development tax credit and why businesses, especially in the brewery industry, are such good prospects for the R&D credit. Next, we'll spend a couple of minutes discussing the employee retention credit. I know that several readers of the Brewer magazine are actually clients of strategic tax planning that we have helped claim the ERC. And there's a lot of misinformation in the space regarding that particular credit, so I want to spend a couple of minutes dispelling some of that misinformation before we move on to discussing the Cheers Act of 2024. And I'm going to bury the lead on that one, but that's a pretty exciting piece of legislation, especially for this industry. Next, we'll talk briefly about the fixed asset planning opportunities. That's a big thing for businesses in this space because there are so many fixed assets that are required as part of the production process for beers and wines and distilled spirits as well. And then we'll also just talk for a couple minutes about what other planning opportunities our team here at Strategic Tax Planning might be able to offer business owners like you. And then finally, we'll wrap it up with a quick Q&A session to make sure that I've answered anything that you all have in mind. So to get started, let's talk a little bit about entity classification. And so what I mean by this is, and I'll say, right here at the top, this title says LLC isn't one of the options. So a limited liability company, while this is a legal entity that is generally established with the Secretary of State in the state or territory where you're operating, an LLC is actually not recognized as a taxable entity type by the IRS. And so there are a few main types of taxable business entities. The first, and we'll talk about this just very quickly because generally sole proprietorships, that is not a business type that most breweries can operate as because of the regulations in the respective 50 states where these breweries operate. But a sole proprietorship, this is actually not a legally recognized entity that is separate from the individual who owns and operates the business. So just to give you a quick example, let's say you have an individual that has a window washing business and they don't establish a separate entity from themselves as an individual. So they're just out there washing windows as John Doe. Well, John Doe would then report the income and expenses from his business operations on what's called the Schedule C of his individual Form 1040, which is what each one of us as individual taxpayers files with the IRS every April 15 to report our income and expenses. But because most of the 50 states, as far as I'm aware, and I'm certainly not aware of all 50 states regulations, however, most of the states in this country, I would imagine, certainly require breweries to operate as a legally recognized entity. So let's say that you establish a limited liability company with your Secretary of State. Well, again, a limited liability company, there's no tax form for an LLC to file with the IRS. And so an LLC, by default, if there is no separate election filed with the IRS, an LLC does file their taxes similar to a sole proprietorship. And so what that means is that if you form an LLC, but you do not notify the IRS that you are going to be filing the taxes separately for that business, you're generally going to report the income and expenses of that business on your individual income tax return as a Schedule C filer. The big disadvantage of this is having to pay both portions of the FICA taxes, of the employment taxes. And so when you operate as a sole proprietorship, which is not an entity that is recognized as being separate from the individual, well, when you file a Schedule C, you end up having to pay both the employers and the employees' portion of both Social Security and Medicare taxes on any portion of profit that is recognized by that LLC, which is taxed as a sole proprietorship. Now, if you have an LLC with more than one owner, generally by default, that entity is going to be taxed as a partnership at the federal income tax purposes, rather, meaning that the partnership is going to file what's called a Form 1065, which is the income tax return for the partnership with the IRS every year. Now, when you're filing as a partnership, it's not dissimilar to reporting your income taxes as a sole proprietorship, just on your individual income tax return. And what that means is that a partnership doesn't actually pay taxes itself as an entity. A partnership is what is known as a pass-through entity, meaning that all of the income or loss, if you had a bad year, is distributed to the partners of that entity. And then those partners are taxed on that income or loss on their individual income tax return, their Form 1040. And so what this means, let's say you have a partnership that has $100,000 in profit in 2023, and you're the 50% owner of that partnership. What that means is that you're going to have $50,000 of taxable income from that partnership that you're going to have to report on your individual income tax return, your Form 1040. And the disadvantage of that is that, again, that individual is going to pay both the employer and the employee's portion of the Social Security and Medicare taxes on that amount of income. Because when you receive income from a partnership, that income is generally taxed as self-employment income on that individual income tax return, their Form 1040. Now, that's subject to some certain exceptions, but that is one drawback to being taxed as a partnership. Now, let's say that you establish a limited liability company, and then you file a form that's called a Form 2553 with the IRS, which is an election form to be taxed as an S corporation. So an S corporation has certain limitations. It can only have a certain number of shareholders, and so this entity structure is generally reserved for smaller business types. But there are a number of advantages to being taxed as an S corporation. So an S corporation is also what's called a pass-through entity, meaning that the S corp, as it's often called, does not actually pay taxes itself to the IRS. What this means is that the S corporation distributes all of the profits from that tax year to the shareholders of the S corporation on a form that's called a Form K-1, which is the same form that's used for partnerships to report their distributive share of income. Now, the advantage of being taxed as an S corporation is that when the shareholders of that S corporation receive their distribution of the profits from that S corp, that is not generally going to be taxed as self-employment income on that individual's tax return. And so what that means is that you're avoiding, in this situation, generally both the employer and the employee's share of the employment taxes, the FUTA and the FICA taxes that are going to be paid generally by the entity. And so what this means is that when the S corporation distributes the profits to its shareholders, these are generally going to be taxed as dividends, which is just treated as ordinary income on your individual income tax returns. Now, again, there are some limitations to how S corporations operate. One of the big ones is the limitation on the number of shareholders. But another important issue to mention is that of reasonable compensation. And so what that means is that an owner that is also an owner or a shareholder of an S corp that also works or performs services for that S corp, well, that individual is required to pay themselves reasonable compensation, so a reasonable amount of wages for those services that are being provided to the S corp. And this is important because this is how the IRS makes you pay some amount of Social Security and Medicare taxes on the money that you're bringing in. So, for example, before I joined Strategic Tax Planning and Frost Law, my current two employers, I used to operate a accounting firm on my own, which was taxed as an S corporation. And I had to pay myself wages as an employee from that S corporation so that I was paying into Social Security, essentially. And so that's one of the drawbacks to the S corporation entity structure, which brings us to the last entity structure that we're going to discuss today, which is that of a C corporation. Now, a C corporation is not always, but generally reserved for larger corporations with a more diverse ownership structure. And so let's say, for example, you have several hundred shareholders of a business. Well, you're not eligible to be taxed as an S corporation. And so in that situation, you would be required to be taxed for federal income tax purposes as a C Corp, as it's often called. Now, the main drawback to being organized as a C Corp is the issue of double taxation. And so what that means is that a C Corp is recognized, again, as a separate legal entity, which is entirely separate from the shareholders of that entity. And then C corporations have to pay a flat 21% income tax on every dollar of profit that they bring in during each of their taxable years. And then after they pay that 21% income tax on whatever profits they brought in, if that C Corp then wants to distribute whatever remaining profits there are to the shareholders of that corporation, then those shareholders are also going to be taxed on those distributions, on the dividends that are distributed to those shareholders. And so what that means is that you have a situation where double taxation arises. So the C corporation has already paid 21% taxes on its profit for that year. And then when the C Corp goes to distribute those profits to its shareholders, those shareholders are also going to be taxed on those distributions at the individual tax level. So again, the selection of how your entity is going to be taxed for federal and state income tax purposes can have really, really big implications on how and when you're able to distribute profits to the owners or shareholders and how those profits are going to be ultimately taxed. So this is a very important decision for every business owner and operator to make, and one that should be reviewed occasionally. I usually recommend my clients review their status every 3 years, just to make sure that there hasn't been any change in ownership structure or change in facts and circumstances that might warrant a different entity taxation classification. So we'll move on to talking about the next big compliance responsibility that I want to tell everybody about today. And those are the beneficial ownership information reporting requirements that were brought about with the passage of the Corporate Transparency Act. Now, the Corporate Transparency Act, also known as the CTA, this is a bill that was passed and signed into law in 2021 during the pandemic. And there were a lot of other things on businesses owners' minds at that time, no question about it. So this is something that has escaped the notice of a lot of my clients, and they did not realize until I brought this to their attention that they have this reporting requirement under the CTA during 2021. And so at a high level, the Corporate Transparency Act, just to go through these bullet points real quick, imposes reporting requirements on most of the corporations, LLCs, and other entities that were created or registered in the United States. And specifically, these reporting requirements include reporting the beneficial owners of that entity, and in some cases also the individual that is applying or reporting the beneficial ownership for that entity. Now, these reports have to be filed with the Financial Crimes Enforcement Network, which is a division of the Department of Treasury. So this is not actually an IRS filing. However, failure to comply with the business's CTA beneficial ownership information reporting requirements can result in a fine of up to $500 per day for noncompliance. And that $500 per day is also indexed for inflation. So as of today, I believe that daily fine is actually already up to something like $545 per day for noncompliance. Now, let's get into real quick, what is a company that is required to file one of these beneficial ownership information reports with FinCEN? So generally, a reporting company is a domestic company, which is a corporation, LLC, or other similar entity, such as a PLLC or a PC, which are other entity types which are recognized by different states. And these that were created in the United States by filing a document with a Secretary of State, or also a foreign reporting company that was registered to do business in any U.S. state or Indian tribe by such a filing. So, for example, here in Maryland, where I live, in order for a company that's overseas, a foreign company, to do business in the state of Maryland, that foreign company has to file a form to register with the Secretary of State here in Maryland. So even that foreign company that does not have a legal entity that's established here in the United States, because it is registered with the state of Maryland to do business in the United States, that business is going to be required to file a beneficial ownership information report with FinCEN in order to remain in compliance with the CTA requirements. Now, a business that was established prior to 2024 has 90 days to file its beneficial ownership information, or excuse me, has until December 31st. I apologize, I got ahead of myself. Has until December 31st of this year to file its BOI report with the corporate, or excuse me, with FinCEN. So again, if you were in operations prior to 2024, you do have until the end of this year to file that report with FinCEN. For any new businesses that are established or registered in 2024, those businesses have 90 days from the date that the business is organized to file that beneficial ownership information report with FinCEN. And starting next year in 2025, any newly organized entities have only 30 days to file that report with FinCEN. So we'll move on now from the compliance responsibilities into the stuff that you're probably more interested in hearing about. And so what are some of the ways that we might be able to save some money and keep more money in your pockets? So first, let's talk briefly about the research and development tax credit. So the R&D tax credit is something that was brought into existence going back to the 70s to incentivize American businesses to keep up with all the technological innovations that were coming largely out of Eastern Asia at that point. So Japan was a real big concern going back to that time. And so Congress brought into existence the research and development tax credit to incentivize businesses here in the United States to try to keep up with all the innovations that were happening around the world. And so at a very high level, the research and development tax credit allows a business to take usually up to 10% of the research and development expenditures of the business during a tax year as a credit or deduction against that business's taxable income. So let's talk a little bit about what are the expenditures that might qualify for this credit. So again, the research and development tax credit, which is found in the Internal Revenue Code section 41, is aimed at encouraging businesses to invest in R&D activities leading to innovation, technological advancement, and ultimately economic growth. But what is qualified research? Well, the term qualified research means research which is undertaken for the purpose of discovering information. So it must be technological in nature, and then also useful in the development of a new or improved business component. And so one thing that I'll point out there is that this does not have to be some entirely new product that you're developing. Even if you are expending funds to research and develop an improvement to an already existing process that your business is implementing, those expenditures could potentially be eligible for the research and development tax credit. Now, again, this research must be implemented in order to further a new or improved function, enhance performance, or increase reliability, for example, of an already existing product. So again, it does not have to be for an entirely new product or even service. Now, let's talk a little bit about how the R&D tax credit can be valuable to the brewing industry and why I find breweries especially are such good prospects for the R&D tax credit. And so I used to do a little bit of home brewing myself. It's probably been about 15 years since I brewed my last ale, but I know pretty well just how quirky the organism yeast can be and how difficult it can be to manage, and what a science experiment every new beer recipe is. You never know how that new Cascade hop is going to implement how the yeast is fermenting the grain in your beer, and there's no telling what that's going to do to the ultimate hoppiness of the beer or the alcohol content of that beer, for example. So what this means is that almost every new recipe for every one of the breweries that's listening in today, this is a research and development project. that is potentially qualified for the research and development tax credit. Now, one of the main requirements of being able to claim the R&D tax credit on a business's a business's R&D expenditures is that there must be some sort of process of experimentation associated with the development of that new product or service. So without question, every new beer recipe, there's always going to be some process of experimentation as you work to reach that, your target, we'll say, what it is that you have in mind that beer should taste like. So again, breweries and wineries and distilleries as well, I think, are especially good prospects for the research and development tax credit. So if you would like to set up a call to discuss how the R&D tax credit might benefit your brewery, please do reach out to set up a complimentary consultation. We'll have some contact information for you in just a few slides. Now, let's talk about some of the recent changes and some of the pending changes to the research and development tax credit. So when the Tax Cuts and Jobs Act was signed into law a few years ago, one of the ways that Congress was able to get so many tax law changes and tax cuts into that bill was they were able to do so via the reconciliation process. And so just at a high level, what that meant was that at that time, Congress was not able to make these tax cuts permanent. All the tax cuts that they brought into existence with the TCJA, as it's often called. And the reason for this is that in order to implement permanent tax cuts, Congress would have had to have gotten to a 2/3 vote threshold in order to get that piece of legislation signed into law. Well, they couldn't do that. They could only reach a simple majority. And so in order to get these tax cuts into that legislation, they had to make those tax cuts temporary. And so many of those tax cuts have been expiring both in 2023 this year and even up until next year, 2025. And so one of the incentives that was affected by the expiration of some of these incentives that were brought into existence by the TCJA is the effect on the R&D tax credit. And so what that means is that after the close of calendar year 2022, so beginning on January 1st of 2023, businesses began to be required to amortize their research and development expenditures. And so what that meant is that a business could no longer recognize 100% of their current year R&D expenditures during the current tax year. They had to spread those expenditures over a 5-year period. And so while that ultimately does not reduce the actual amount of the incentive that is available to that business or that taxpayer, it certainly does change the math on how and when to take advantage of the research and development tax credit or incentive. Now, the R&D tax credit has also, let me back up a sec. Excuse me. There is currently a piece of legislation called the Tax Relief for American Workers and Families Act that is actually going to be considered by the Senate later on today. That's calendared for consideration just 5 p.m. this afternoon. Now, this tax bill, we'll just call it for short, this was passed pretty overwhelmingly by the House of Representatives going back to the last week of January of this year. And this piece of legislation, the way that it would affect the R&D tax credit is by restoring 100% current year expensing of all R&D expenditures. And so again, that kind of reverts the math back to, well, when and how do we take advantage of the R&D incentive, reverts it back to the situation that we were dealing with going back to 2022 and prior to that. So let's talk about, for a moment now, the CHEERS Act of 2024. Now, this is a pretty exciting one for your industry especially. So the CHEERS Act, this stands for Creating Hospitality Economic Enhancement for Restaurants and Servers Act of 2024. And so this particular incentive is really more targeted toward the end user of our 3-tiered alcohol distribution system that we have here in America, meaning that this is more targeted towards restaurants, bars, and entertainment venues, because this is the specific audience of this particular piece of legislation. And so what this piece of legislation would do is make what's called the 179D incentive available to taxpayers that installed energy efficient keg systems in their restaurants, bars, or entertainment venues. Now, what is the 179D incentive? So this is the federal tax incentive that was brought into existence in the last few years that incentivizes businesses and taxpayers for installing energy efficient commercial business properties. So usually things like geothermal heat pumps or solar panels, these sorts of things, or special types of insulation to make sure that a facility is able to retain energy more efficiently. Well, the CHEERS Act would make this particular incentive available again to businesses that installed energy efficient keg systems, which is a pretty cool thing because, as I'm sure everybody that's on this call realizes, the last few years since the since the onset of the pandemic have been pretty tough on certainly craft breweries as a whole, but also just draft beer more specifically. So I'm pretty excited to see this piece of legislation. My understanding is that this is supposed to be considered by the House of Representatives sometime in early April, so sometime next month. Now, again, this particular incentive is more targeted toward the end user. And so think, again, bars, restaurants, and entertainment venues are the specific business types that are written into the proposed legislation. But for the breweries that are on the call today that, for example, have a tasting room or a brew pub that's attached to your brewery, there's good potential that that portion of the facility might be eligible for this enhanced 179D incentive that's being brought into existence as part of the CHEERS Act. So it still remains to be seen if this piece of legislation is going to get signed into law. But if it does, again, that is going to significantly enhance the tax incentives that are available to these people that are pouring beer from draft keg systems. And so whether or not your brewery is able to take advantage of it, this is something that should be exciting for you because this is certain to increase the demand for your draft beer products. So again, I think a pretty cool incentive. I'm very excited to see how this all plays out. Okay, so now let's move on to our discussion about the employee retention credit. And so I don't want to spend too much time on this, but I know that many of the individuals or taxpayers, I should say, that are in our audience have filed claims for the ERC, as it's called, with the IRS. And I know this because, again, a number of the readers of this magazine are actually clients of strategic tax planning that we help claim the employee retention credit. So what's going on with the ERC these days? So the IRS recognized last year that there was a great deal of fraud and fraudulent claims for this credit that were being submitted. And this has really increased over the last year. And it's unfortunate because this is a credit that was brought into existence during the pandemic to assist affected taxpayers and businesses and employers keep staff on payroll so that they could continue paying their staff, so that their staff could continue paying their families, or feeding their families. But unfortunately, because the legislation was not especially well written, nor was the interpretive guidance from the IRS especially well written, unfortunately, that left a lot of room for fraud. And so we've seen a great number of bad actors in this space that have cropped up over especially the last year or so. And as evidence of this, the IRS issued in the between December and January, in the last couple of months, issued a total of 40,000 rejection notices to businesses that had tried to claim the ERC. But these were completely fraudulent claims, literally for businesses that were made up businesses or businesses that were filing claims for made up employees. So obviously there's a good deal of evidence of fraud in this space. So if you have not already explored the employee retention credit, make sure you're working with a trusted and licensed tax professional to do so. But the IRS's reaction to all of these fraudulent claims that were being submitted was to implement a moratorium on the processing of newly filed ERC claims. Now, this moratorium went into place on September 14th of last year. However, in reality, the IRS had stopped processing claims for the ERC a couple weeks prior to that date. Now, at this point, there was a there was a recent news release last Thursday or Friday from the TIGTA, it's called, the Treasury Inspector General, that said the IRS's moratorium on the processing of these claims should be lifted sometime later this spring. Now, when the IRS implemented this moratorium last September, there were approximately 630,000 claims in their inventory that were awaiting processing at that time. And then there are still a great number of businesses that continued to submit claims even after the moratorium was implemented. And so my understanding is that that inventory of claims awaiting processing now exceeds 1.3 million of these things that are sitting at the IRS waiting for them to be processed. Now, let's talk a little bit about the tax bill that I mentioned a couple minutes ago, the Tax Relief for American Workers and Families Act. So this bill, and let me also give you a little bit more context regarding this bill. So this bill was passed by the House of Representatives in, like I said, late January of 2024. And then it was sent to the Senate, but the Senate has not actually even taken a vote on this bill yet. Again, they are going to be considering this piece of legislation later today, but this bill is not yet law, and it is not at all certain that it is going to be passed by the Senate in its current form. However, as it is currently written, as it was written by the House of Representatives, this bill, if it is eventually passed by the Senate and signed into law by the President, would end the ERC program early, as of January 31st of this year, 2024. And this would be an ex post facto early closure of that program. Now, if this does get signed into law, what that means is that any claims for this credit submitted after that date will ultimately be rejected by the IRS. And then the other big implication of this piece of legislation for the ERC program is that if this bill is signed into law eventually, it is also going to extend the statute of limitations on the IRS being able to audit these ERC claims. And this is something that the IRS has been requesting over the last several months, particularly in response to the volume of fraudulent claims that they've been receiving over the past year. So let's talk real quick again. What if you have not yet explored your business's potential eligibility for the ERC? Well, first, let me tell you that there is limited time remaining to act. So as the law currently stands, so again, if this tax bill, the Tax Relief Act, does not get signed into law, then businesses have until April 15 of this year, so a little bit less than a month from now, to file any claims for the ERC for the quarters in 2020. And then until the following April 15 of 2025 to file any claims for the quarters in 2021. But again, that's if this tax bill does not get passed. If the tax bill does get passed, then what that means is no claims filed after this most recent January 31st will be honored by the IRS. However, there's still a good deal of uncertainty as to whether or not this bill is actually going to get signed into law. Now, if you are still interested in exploring your business's potential eligibility for the ERC, we'll be happy to provide you with a complimentary eligibility analysis. However, because of the short timeline remaining, we are going to need to get any sort of relevant information for that analysis in just the next few days. So again, if you are interested in exploring your eligibility for this credit, please reach out to Mike. His contact information is on the screen and will be coming up again in a few more slides. Now, what if you already claimed the employee retention credit? Well, first, let's talk about, are you still waiting on your refund? So like I said, there is this moratorium in place that has been in place since September 14th of last year. Now, this moratorium was supposed to only affect claims that were filed for the ERC after that date. However, the IRS has been processing only a small handful of our clients' claims, even those that were filed prior to the implementation of that moratorium. So while the IRS has said they are going to continue to process pre-moratorium claims, we've really not seen that to be the case. Now, there are a couple of options that you may have available to your business. The first would be to file a request for assistance with the IRS's Taxpayer Advocate Service, which is something that we can assist you with here at Strategic Tax Planning. So the Taxpayer Advocate Service is actually an office within the IRS that advocates for and on behalf of taxpayers with the other offices and divisions within the IRS. And so that is probably our best option for most taxpayers to try to do something to speed up the IRS in their processing of their ERC claims. Now, in other certain more limited situations, there is actually potentially some judicial relief for a stalled ERC claim. And what this means is that when a taxpayer files a claim for refund with the IRS, and the IRS does not act upon that claim for refund within a 6-month time frame from the filing of that claim, their local federal district court then gets jurisdiction for that taxpayer to file a refund claim lawsuit in federal district court. And because Strategic Tax Planning is not organized as a law firm, we would not be able to assist you with that here at STP. However, we have partnered with some law firms who are assisting our clients with pursuing those refund claim lawsuits in federal district court. And those actually can also be filed in the U.S. Court of Federal Claims just up the road here in D.C. Now, if you have filed your claims for refund and you worked with, we'll just say, one of these bad actors in the ERC space, and maybe you're a little bit uncomfortable about the position that they took, or maybe you didn't receive sufficient support for the position that was taken on those ERC claims, well, we're also here to help with that. And so the legal scholars are on staff here have combined probably at least 20 or 30,000 hours of experience over the last several years researching all of the government orders that were in place in all the jurisdictions around the country. So we can help you build out your repository of the government orders that provide the basis for your having filed an ERC claim. And our talented team of accountants and CPAs can also help you verify the calculations of the credit that were provided to you by your ERC consulting firm. And then finally, and I hope this isn't the case for anybody on the call today, but if you've been selected for audit, whether it's of your ERC claim or any other tax matter with the IRS, we're also here to help with that. So the tax professionals that we have on staff here at Strategic Tax Planning have combined many decades of experience in audit support and representation before the IRS, and then also negotiations with the IRS for things like offers and compromise, installment agreements, etc. So if you have a current controversy issue with the IRS, please reach out. We're here to help. So moving on, I just want to talk briefly about some of the other remaining planning opportunities that are out there for businesses in this particular space. And so one of the first categories that I want to talk about are the fixed asset planning opportunities that are available to breweries and also, again, wineries and distilleries. But because there is so much equipment that is required to brew or distill alcoholic beverages, and that equipment has to be housed in some sort of building, many of the breweries that we've worked with have pretty significant fixed assets on their balance sheets. And so one of the first and most lucrative opportunities that are available to businesses that have large numbers of fixed assets on their balance sheet is the opportunity to perform a cost segregation analysis. And so a cost segregation analysis largely centers around the idea of accelerated or bonus depreciation. And so without getting too much in the weeds and making your eyes glaze over, what this means is accelerated depreciation is a practice by which businesses can take a current year expense deduction for a fixed asset that has a useful life of less than 20 years. So I'll give you an example. Let's say that you have, you put an HVAC system, a new HVAC system into service in the building that you own for your business. Well, that HVAC system typically is going to have a 7-year useful life. And so what that means is that business can generally take under the current law, now there are some pending changes to that, but under the current law, that business can generally take a 100% current year bonus depreciation deduction for that HVAC system, just to use a basic example for you. And so what that means is that rather than spreading out that deduction over the next 7 tax years, that business can take the entire deduction for that system in the current year, meaning that that's an opportunity to significantly mitigate that business's taxable income in the current year. And so what a cost segregation analysis is, and what that does, is our team of accountants would, for example, take one of your fixed assets that involves, or includes rather, systems that have differing depreciable lives, and try to identify what systems or what components of that fixed asset might have the potential to take an accelerated depreciation deduction. And this is especially useful for businesses that are as a tool to plan how to smooth out their taxable income over future years. Which brings us to the next bullet point here, which is asset purchase and disposition planning. And so this plays into the concept of cost segregation analyses as well. So let's say that you plan on expanding your brewery and buying a new building to house the brewing equipment for this expansion. Well, first of all, that new building that you're purchasing is a right prospect, for a cost segregation analysis, because at the time of purchase is the most advantageous time to perform that cost segregation analysis. However, if you're planning on purchasing a large fixed asset and that fixed asset has components that might be eligible, for example, for accelerated depreciation expense deduction, then that is another useful tool to be able to mitigate especially high taxable income in the current year. So again, if you're planning, or if you expect to have a particularly profitable year this year, or whenever you are having a successful year, it's not a bad idea to think ahead and think about, well, maybe this is a good year to start planning some of these big purchases that we've been putting off recently. And at the same time, the same thing is true with the disposition of these fixed assets, is particularly for the disposition of assets that will show a loss on disposition. And so what that means, let's say you have a big fixed asset. Let's say you have a building that in a neighborhood that's gotten to be, well, not such a great neighborhood over the last few years. And you know that when you go to sell that building, that you're going to be recognizing a loss on that sale. Well, this is another useful tool and another arrow in the quiver that we can use to plan on how to mitigate your tax burden in a particularly profitable year. And then just to get back to the legislative update, so this tax bill that I keep mentioning that the Senate is going to be debating later on today, one of the things that they're going to be discussing and debating is restoring 100% current year accelerated depreciation deductions all the way through the end of the 2025 calendar year. So on the next slide, and I'm just going to go slide through this one pretty quick so I can leave a couple of minutes for questions and answers here at the end. But let me just say from a high level, strategic tax planning, we have a very, very diverse group of financial professionals, including enrolled agents such as myself, CPAs, certified financial planners, estate planners, personal financial specialists, Juris Doctorates, and many, many other types of very experienced professionals on staff. And so there are lots of planning opportunities in the tax code. Let us talk to you and see what we might be able to do for you, because whether it's something like cash flow planning and budgeting, risk mitigation, being able to help for board presentations or other outsourced CFO services, reviewing your 401k, or just doing some basic personal financial planning, there's a lot that we can do to help you keep more money in your pocket. So with that, I'm going to go ahead and move on to the next slide and then send this over to Mike for him to feed me any questions that have come up during this presentation.
Matt, thank you. Yeah, we actually do have a question. Does that apply to existing businesses? We have been a legal entity since 2011. So I think that question came in right as you were talking about the CTA and BOI.
Yeah, so if you organized that entity in 2011, even if you never actually operated an active trade or business via that entity still has a reporting requirement to FinCEN during 2024. And because, again, that entity was organized prior to the beginning of this year, that has to be filed with FinCEN by December 31st of this year.
Also staying with that one right there, what happens if somebody has more than one business that might be outside of the brewing industry?
Yeah, so depending on a certain number of factors, it's not unlikely that each one of those businesses may have to file a beneficial ownership information report with FinCEN. Just to give you one example, I actually had a client that I was speaking with, I guess this is about 2 weeks ago. This gentleman is a real estate professional in the state of New York and has something like about 40 different investment properties. Each one of those properties is owned by a separate LLC. And so every single one of those LLCs, even though it was only created simply to house that asset, every single one of those 40 plus LLCs has a beneficial ownership information reporting requirement with FinCEN this year.
Thank you, Matt. And also, I know we're getting close to the end of the time here, but also wanted to squeeze in one more question. What kind of records are needed to evaluate for the research and development credit?
Yeah, absolutely. So really the best way to start is to set up a call with John Althouse, who is our Director of R&D here at Strategic Tax Planning. I think that's probably the best use of your time. He'd be able to discuss with you for a few minutes if you're a good potential prospect for the R&D credit, and also should be able to give you a relative idea of what the total credit or incentive that might be available to your business is. And before I move on from that point, let me just throw out one other thing about the R&D tax credit. And this is for all of the newly opened breweries that are on the call. This is an interesting one because the R&D tax credit is something that can actually be taken advantage of as a payroll tax credit with the IRS. So even if your business in the first couple of years of operation does not have a profit and does not show any taxable income on its IRS income tax return, this is still potentially a credit that your business can take advantage of via its payroll tax return to the IRS.
That sounds great. Want to wrap things up here real quick. Thank all the brewers that were on the call today. Thanks to Brewer Magazine. And please don't hesitate to reach out to us with any questions or concerns about any of your tax needs.
Awesome. Thank you so much, Mike. And thanks everybody else. You all have a wonderful day. Take care.